Hi everyone, this is Sam from Phillip Research and welcome to this week's market commentary. Today I'll be walking you through the fundamental economic developments taking place in India and the outlook of its economy. In around April we upgraded our outlook on India to overweight, and since then it has worked out phenomenally well. We still continue to remain overweight on Asia's third largest economy, which is poised to grow at a moderate pace of 4.8% this year. I'll first start with the economic fundamentals, which at this point in time remains solid. Since the new government took the stage, the economy seems to be revitalizing. The latest release of GDP numbers reveals that the economy expanded 4.6% in second quarter, and it added annual growth of 4.7% in the financial year of 2013 and 14. Now, growth in India's economy was mostly spurred by the pickup in the agriculture sector. However, manufacturing, mining, and construction sector performed below expectation. In the last two quarters, due to the lackluster infrastructure about which I will be discussing later, growth in consumer durables, which represent overall consumer demand, and capital goods, which represent investment demand, which was mostly negative last year, has already rebounded, weighing investment-led policy that would spur further demand. Consumers remain concerned about persistent price increase, especially of food items. Although inflation has been trending down as confirmed by the past 4 months data, upward pressure on wholesale price inflation is still high, and consumer price inflation still remains above the RBI target, hovering around 7% year-on-year change. Curbing inflation remains the government's immediate and uttermost priority. Recently, the government imposed export restrictions on certain farm commodities, mostly vegetable articles, and ordered a crackdown on food hoarding to control rising food prices. The government also plans to release additional rice stock to prevent inflationary expectations from building. The question is, what is the cause for the inflation, especially in food? Well, to answer it simply, it's an outcome of structural deficiencies in the economy, which includes, and not limited to, shortages of warehouses facilities, high dependence on monsoon rain, and a sophisticated web of middlemen that has resulted in irregular supply of agricultural products. For this year, meteorological predictions are for a lower than average monsoon rainfall that may stymie the government's efforts to contain the upward spiral of prices. But overall, new government's fiscal policy and RBI's monetary policy has helped contain inflation effectively, which suggests that the government is on the right track. The external sector has continued to improve. The current account deficit narrowed to 0.3% last quarter, and the imports have remained below expectation, primarily due to the steep drop in gold imports. The past credentials and reputation of Prime Minister Narendra Modi has generated high expectations for an investors' business-friendly environment. FIIs have turned bullish on India once again, as evident from the reversal of capital flows and the stock market rally since the BJP took over the government. However, it is the foreign direct investment (FDI) that remains to be an important gauge to ensure a sustained source of capital investment. The government has already paved way, permitting 100% FDI in the defense sector. Now the aim is to relax regulation on the foreign investments in the railway sector by allowing 100% FDI in high-speed railway systems and dedicated freight lines. The development and the advancement in the railway sector is critical to drive growth through direct and indirect economic linkages. Substantial investment through FDI to upgrade and modernize this sector has huge potential to raise India's GDP significantly in future. Indian equity market has continued to rally and has managed to garner returns of around 25% year to date. Sectors such as auto industry and healthcare have been the outperformers so far due to the potential government policy changes towards these industries. Forward PE wise, market is still trading at around 17.08 level, even after 25% gains, which is still below its a long-term average of 18.05. Now, Indian rupee bonds may also outperform other regional bonds. Bond yield looks attractive currently, considering gradually rising room for policy easing and reduced risk to the currency devaluation. In fact, Indian rupee has remained resilient since last few months due to improvement in economy and foreign inflows into stocks. We might expect a mild appreciation in the currency by the end of the year, relying on heavy FII and FDI inflows. After having talked about what picture the economic indicators and financial market is catching for now, let's move on to discuss current fiscal, budget, and structural policies, and then we will end this commentary with a brief discussion on India's monetary policy. One of the main reasons for the Congress Party defeat in the recent election was that they significantly deviated from their set fiscal target mandated by the Fiscal Responsibility and Budget Management Act. Populist policies and high subsidies caused the gross fiscal deficit to spiral from 2.5% of GDP in 2008 to 4.6% of GDP in 2013. The rising deficit was seen as a major cause of worry to investors who were hoping for some fiscal consolidation move. The first step Modi's government took since after the election was to restore the country's financial discipline and self-confidence. The government has announced a hike in railway fares and freight charges to improve railway finances and reduce subsidies, boosting the revenues. In addition, the government has proposed the divestment of public sector undertakings. It will likely suggest other prudent measures to check the fiscal balance without compromising a push on investments in infrastructure. The government has showed quite an urgency to deliver its top 10 policy priorities, and within 2 weeks of its inception, it sought to unblock investment-related bottlenecks and set deadlines for action in order to revive the economy. The government is determined to emphasize 3 major issues: efficient governance, delivery, and number 3 is the implementation of projects. These issues include improvement in infrastructure components such as healthcare, water supply, education, roads, and etc. The objective of the 10-point vision is to increase investment, complete infrastructure in a time-bound manner, and efficiently utilize natural resources. The recent budget has also introduced several promising key points as well, such as increasing FDI limits in the insurance and defense sectors, encouraging banks to boost infrastructure trading through exemptions in statutory requirements for these types of new loans, and a push for urban infrastructure, including roads and tax reforms to open up the REIT market. The government is also considering diluting its stake to 51% in public sector banks to comply with additional capitalization of Basel III framework. In coming months, the government would likely focus on reviving the manufacturing sector as well, which has slumped in recent months like I mentioned earlier, largely due to the structural bottlenecks and policy paralysis. The government has already indicated that such pending projects will be prioritized and put on fast-track mode to gain investors' confidence. The central government would work closely with the state governments to tackle issues such as land acquisitions and tariffs in the power structure, which are the biggest impediments to projects. Structural reforms such as rolling out goods and services tax and the investment cycle in the economy, reviving special economic zones, discussing issues related to free trade agreements, and relaxing rigid labor laws will likely be part of policy making to boost manufacturing in the future as well. A turnaround in the manufacturing sector will likely help generate growth in GDP and in the employment as well. On the monetary front, RBI remains determined to continue its war against inflation, and the recent data suggests some success in curbing it as well. Ultimately, victory through would depend on closing the infrastructure gaps in the economy. Based on that, RBI has decided to leave the policy rates unchanged in its latest monetary policy meeting, as the plunge in inflation needs to get sustainable before RBI can even think of getting a rate cut, especially since lower than average monsoon will put pressure on the inflation, making RBI more cautious. However, the statutory liquidity ratio of scheduled commercial banks was cut by 50 basis points, which will likely improve bank lending to investments. In other words, the RBI governor has signaled that growth will likely not suffer on account of lack of liquidity, though he will keep a close watch on inflation. To summarize and to conclude the entire thesis, we believe the new government's effort to remove bureaucratic bottlenecks and measures to attract local and foreign direct investments will lead to a growth rebound. A decline in inflation would also release pressure from RBI, which would then loosen its monetary policy as well. However, it will be a tough balancing act for the RBI. If the current economic scenario is viewed dispassionately, India needs more than just monetary policy to correct its course. Government authorities will have to work hand in hand to manage the fiscal account and address structural deficiencies. We have also listed few unit trusts that proxy Indian market for you to take note. With this, we end our market commentary. Hope you found it useful. Thanks for watching it, and until next time, so long.